Qualifying for a mortgage after bankruptcy, foreclosure, short sale, and collections. Qualifying for a mortgage after a Chapter 7 bankruptcy. A Chapter 13 bankruptcy. A foreclosure includes deed in lieu of foreclosure, the short sale of a property, collection accounts, late payments on loans or credit cards. There is hope. Before we start, understand that none of any of these are things that will prevent you from ever obtaining a mortgage. None of these 6 things are a lifetime ban or prevent you from obtaining a future mortgage loan. Definitions of bankruptcy, foreclosure, short sale, and collections. Chapter 7 bankruptcy is to discharge certain debts, to give an honest individual debtor a fresh start. The debtor has no responsibility for discharged debts. A discharge is only available to individual debtors, not to partnerships or corporations. Chapter 13 bankruptcy is also called a wage earner's plan. It enables individuals with regular income to repay all or part of debts. Debtors propose a repayment plan to make installments to creditors over 3 to 5 years. Foreclosure occurs when lender has to use the court systems to force the sale of the property. Short sale occurs when lender and debtor agree to sale of property for less than mortgage balance, so deed in lieu. This is treated like a foreclosure. Owner agrees to forego judicial process and transfer property to bank. Late payments on loans and credit cards. The most important thing you can do is to start making timely payments. Lenders do understand that things happen to cause payments to be missed or overlooked. Recent late payments are more detrimental to credit scores. Time is on your side as long as payments are consistent and timely. Paid or unpaid collection accounts. The lenders may require you to satisfy any outstanding balances on unpaid collections. Credit scores are based upon credit history. Randomly paying off accounts is not a quick fix. Talk to your lender as you work on a plan to buy a home. Lenders do not always require all collection accounts to be satisfied. Example: medical bills. After Chapter 7 bankruptcy, FHA loans, you'll be able to qualify after you can show 2 years of clean post-bankruptcy credit. Conventional loans, you'll be able to qualify after 4 years with a clean post-bankruptcy credit history. VA loans, you'll be able to qualify after you can show 2 years of clean post-bankruptcy credit. USDA loans, applicants will be eligible for this loan 3 years after receiving a Chapter 7 discharge. Clean means re-establishment of credit with a satisfactory payment history. See extenuating circumstances, as shorter times may apply. After a Chapter 13 bankruptcy, FHA loans, 1-year payout has elapsed and payment performance is satisfactory. Court approval required and court approval received. Conventional loans, 4 years from the date of dismissal by a judge. BA loans, 1-year payout has elapsed and payment performance is satisfactory. Court approval required. USDA loans, 1-year payout has elapsed and payment performance is satisfactory. Court approval required. After a foreclosure, FHA loans, 3 years from the completion date. Conventional loans, 7 years from the completion date. With a 10% down, 3 years from completion. VA loans, 2 years from the completion date. USDA loans, 3 years from the completion date. See extenuating circumstances, as shorter times may apply. After a short sale, FA loans, 3 years from the completion date. Waiting period not required if borrower is not taking advantage of declining market conditions and borrower kept account current up until completion date. Conventional loans, 4 years from the completion date. BA loans, 3 years from the completion date. Waiting period not required if borrower is not taking advantage of declining market conditions and borrower kept account current up until completion date. USDA loans, 3 years from the completion date. See extenuating circumstances, as shorter times may apply. Understanding extenuating circumstances. In order to be considered extenuating circumstances, the lender must receive written explanation as well as documents to support why they should give a second look at the borrower. Generally, extenuating circumstances are one-time life events. Divorce, change in employment or loss of overtime income generally does not qualify. Loss of income caused by death or disability of the primary wage earner, or significant medical expenses are likely to qualify. It is best to talk honestly with your lender about your situation. I look forward to assisting you. Tim Bradford, American Midwest Mortgage. Call 216-324-8113 anytime. Doing good things for good people, one generation at a time. NMLS 1420662500113 Ohio 8033890077173.